Rates have been unusually low by historical levels since the start of the financial crisis in 2008, a situation which, according to some analysts, have been exacerbated by central bank policy differentiating from different countries. Here to discuss rates and bonds is Chris Toms. Chris, thank you very much for coming in today.
You're welcome, Monica.
Now, if we firstly begin by looking at the US, it was an interesting week. We had talk from the FOMC and people were looking for a little bit of clarity. Now, there was nothing hugely radical from the meeting that came out, but some analysts are saying it might put a ceiling on the rate of the yields. What are you thinking about this movement that we've seen over the past weeks or so?
Okay, well, over the last 2 months, yields have moved sharply higher. They've come from about 1.7%, rocketing up to 2.7% in just a very short period of time, over perhaps 6 weeks. This was triggered by Ben Bernanke mentioning that the tapering will start at some point soon. A lot of people jumped on the bandwagon and quickly decided it was going to be September, and hence bonds sold off massively, rates went a lot higher. Since then, we had good non-farm payroll data, which helped bonds sell off and rates go higher. And then Ben Bernanke had to come in on the 19th of June and state that rates, or suggest that rates have perhaps gone too far. And that calmed the market down again. We've come back into around 2.5% rate. So now people are looking at the tapering and suggesting that perhaps it's not going to be September, it'll be like maybe December or January of next year. And interest rates might even start rising 2014. Just a few weeks ago, some people were crazily thinking that it might be sometime at the end of 2013, but it should be a bit further out than that.
Now, it does seem as though Bernanke had to come in and rein things in a little bit, but if we look at Europe for a moment, there, quite a contrast. Still mired in recession, still a lot of concerns there, and the gap between the German bonds, for example, and the US Treasuries has been its widest for 7 years. So, how would you sum up this situation that we have over here across the water, if you will?
Well, ECB's Mario Draghi is not a happy bunny at the current situation. As soon as US Treasuries started plunging, German bonds followed, given high correlation between the two. So German or European interest rates went high as well. ECB came out and made a statement when they kept rates on hold and suggested there were still some downside risk factors. Risks remain skewed to downside, and that rates will stay the same or possibly lower for an extended period of time.
Now, Chris, something which is interesting is if we look at the UK, and it would actually seem that gilts there, or actually investors are more confident in the British economy than perhaps Matt Carney is. So how would you describe this situation at the moment? What's the reason for this divergence in confidence, if you like?
In the UK, there are some green shoots coming through. However, the Bank of England is in the same or very similar situation to Europe. They have issued a dovish statement on July the 4th. They do not want the interest rates to shoot right up far too quickly. They've got to control it as well. So whilst there might be some green shoots coming through, there's still a lot of downside risks to the UK as well, and it's important that these risks are eliminated before interest rates rise too quickly.
Well, it does seem as though there's certainly a lot going on, and I guess whether or not these divergences will even widen further depends on the relevant economic outlook for the different regions. But how would you sum up the general overview as we head into the summer months?
In the short term, summer months, markets are going to be volatile. There's going to be a lot less liquidity. Markets do tend to trade in a range, so we'll probably see that through the summer. Going forward after that, we are going to see a normalisation of rates, especially more so in the US. Europe and the UK will lag behind a bit. So that's therefore going to also mean that the US 10-year Treasury versus the bonds, and also the Treasury versus the gilt, those spreads will widen going forward as well.
Normalisation. It does sound as though it could be something to look forward to, but Chris, thank you for coming in and sharing your perspective with us today.
You're welcome. Thank you for having me.
Well, that's all from Chris and myself for the moment. Don't forget to click back to the Dukascopy website for the weekly wrap-up. Goodbye for now.